Hey everybody, Brian from quantlabs.net here. Just want to talk to you about basic performance as a, well, in my case, trader wannabe and a trader newbie. We'll leave it at that. But I had my social din-din a few days ago and we were talking with one person about performance and what the real benchmark should be in terms of performance. I say it should be the S&P 500 and I'll show you why. All right. So let's say you want to use the S&P 500 as the benchmark, okay? When you look at over here at Wikipedia and all the performance over the last number of years, there's a few things that I think people need to understand. This has been tracked since 1970. So if you're just a Joe Blow, know nothing about trading, know nothing about investments, this is the typical place I would always recommend people. And look at the type of performance you get just from one asset that just measures the entire market of the S&P 500. But here's the performance you get. Okay, so you get a couple of negatives. We expect those, and they're pretty steep. But on the other hand, the following year, you could easily get, the following year will wipe out this one, okay? When you're living in a world of 2%, 3%, these kind of averages easily get equalized by the following return of another 20%. Just these alone. Negatives, positives, now you're already up. Following year, now you're up now 25%. So if you start focusing on the really bad returns of this, just 2 years you're already back to where you were, okay? And you get returns like this. So the question is, when you watch these talking pinheads, as I call them, guys pretending, well, the market's going to do this, and we're going to buy that, and we're going to do this, and maybe it might be a hunch, maybe they use technical trading for that analysis to come up with that hunch. And as I always say, in the data, however you measure it, from a quantitative, from a technical, from a fundamental aspect, those numbers don't lie. The projections may be off if it's done the wrong way, which is 99% of the time. But the question is, why would you want to pay people that are going to always miss the S&P 500 benchmark? Doesn't make sense, right? Now, on the other hand, you're paying a bank, you're paying a mutual fund, or somebody, somewhere, somehow, money so you can allow them to have a lifestyle of living in multi-million-dollar yachts and Ferraris, and that's your money that's being basically lining their pockets. So these are questions you need to ask yourself. So that's why I'm doing automated trading. That's why I do quant, HFT, all that fun stuff. I'll get that in a minute. But overall, here's the median for the entire measurement, 12% every friggin' year. That's pretty good consistently for doing nothing. Now, when you start looking at where can you put your money as a so-called investor, look at what you can do. You get any of these ETFs. Now, notice they're not mutual funds, ETFs. Their expense ratios are not even 1%. Here's my favorite, and they're the lowest at Vanguard, and I'm going to show you some resources why I think Vanguard are really good and why HFT enables them to be really good. On the other hand, you still have these iShares, 0.07%. You have the Spider at 0.11%. Okay, let's talk about the performance of these guys. Here's the Spider 500 or S&P 500 ETF. Remember, ETF. And again, here's the overall performance this year. So we're looking at November 24th performance. It's not bad. It's gotten back to where it's at on the S&P 500 performance, and it's up again. Yay! So that's a pretty safe investment. You just park your money here, and statistically, you are at median since 1970 at 12%. That's a hell of a lot better than a bank, a bond, anything that you're going to buy. Okay, safe bet. Now let's talk about beating that. Now, when you talked again about all the stupid pinheads that you see on places like Bloomberg, CNBC, all these jerk-offs going on about this, by that, I don't know where they get their info, but if they ain't beating the S&P 500, what good are they to you? Why should you listen to these people? So the question becomes then, what are the percentage of those guys and those gals that are so-called professionals that are beating the S&P 500? Well, I got two calculations that have come up through what I want to watch Bloomberg, is that only 20% in 2014 have beaten the S&P 500. Again, let me repeat that. Only 20%. So 80% of those professionals you put and you rely on for your retirement, for your lifestyle, only 20% of those professionals are beating this benchmark at 20%. So once again, you could easily park your money on your own without paying hefty fees, and you don't have to do anything. You just park it, and you're going to get that kind of performance paying these kind of expense ratios for, on average, statistically since 1970, only 12%. Ask yourself, you got to be a bonehead to do it any other way. So let's go about it. Talk about Vanguard and the importance of things like Vanguard and the importance of things like HFT and quant. Okay, why is Vanguard pretty well dominating the ETF market? It's because they're using HFT. Now, I did this video a year ago, and this video will explain why Vanguard for 2013 dominated the mutual fund market, okay, or the ETF market. I have no idea. It's a year later. I don't know what the performance is doing, and personally, I don't care. But this is just to prove why things like quant and HFT do really well in the industry of financial analysis and basically investment. Okay, so this is the video. I'll put the video in my blog so people can be refreshed and understand that. I thought I'd put that out there. So again, you need to ask yourself a very simple question. You want to play the game of trading, you want to play the game of retirement savings, and play the game of, let's call it wealth management, money management, or whatever. If you ain't beating 12%, and again, 80% of the population pretty well aren't, and they're paying for the privilege of not beating the market, yeah, this is where you go. You put your money into these guys with a very low ratio. And there's a new video put out by Tony Robbins about this. And you don't have to buy anything, just watch it, understand it. But again, this is what he's talking about, is you put your money into these ETFs at very, very low expense ratios, okay? So I hope to God this helps you. I hope this to please do yourself. If you don't have the time to focus on the intelligence of the technical chops, but you want to make money earning, again, statistically proven median since 1970, 12%, put your money into the ETFs. These three. Highly liquid, very cheap, and you get performance. You don't have to park your money in dumbass banks and mutual funds. This is where you go, okay? Hopefully, this opens your eyes. It opened my eyes, and that's where a lot of my money is now going to be going, that I've educated myself and have a little small portion in a trading account so that I can automate trade and scale it and maybe take money out of these kind of vehicles, these ETFs, and put them into my automated trading account, into some kind of brokerage, and build a nice future with it. Okay? Over and out. I hope this helps you out. And again, my name is Brian Downing from guess where? quantlabs.net. Talk to you later.